For decades, General Electric was the American conglomerate. But after one of the biggest corporate makeovers in modern history, a new, laser-focused company has emerged, GE Aerospace. So today, we're going to break down exactly what this new company is, and more importantly, whether it's a smart investment.
Right. After years of restructuring, what a lot of analysts are calling the Great Unwinding is finally done. The complex giant that used to make everything from light bulbs to owning movie studios, well, it's been systematically dismantled. And this all culminated in the 2024 spinoff of its energy business, GE Vernova. So what's left behind is a pure-play aviation powerhouse. And that brings us right to the heart of the matter for any investor looking at this thing. Now that it's standing on its own, what exactly is GE Aerospace? And does it represent a really compelling opportunity in today's market? To answer that, you first have to understand how the company actually makes its money. Because really, the way GE Aerospace operates, well, that's the key to the entire investment thesis. It all comes down to a classic business model, the razor and blade. So step one, you sell the jet engine, that's the razor, and you often do it at a really low margin, sometimes even at a loss. Now, why would you do that? Because you're playing the long game. The goal is step two, build a massive, and I mean massive, installed base of your engines on planes all across the globe. Which leads to the most crucial part, step three. You get to generate decades of high-margin, recurring revenue from servicing those engines. That's selling the blades. And when we say massive, we're not kidding. GE has the largest installed base of commercial engines in the entire world, with roughly 44,000 of them in service right now. Every single one of those engines is a future revenue stream. It creates this captive market for parts and repairs that can last for 20, even 30 years.
And here it is, the proof is in the pudding. A staggering 70% of GE's revenue doesn't come from selling shiny new engines. Nope, it comes from that stable, predictable, and super profitable services business. You see, this isn't just a manufacturing company. It's more like a services annuity.
Okay, so now that we get how it works, let's build the optimistic case for the stock. Why are investors so excited about GE Aerospace right now? Well, it really boils down to the company riding not one, but two powerful supercycles at the same time.
First off, just look at their competitive position. In the most important part of the market, we're talking the single-aisle jets like the 737 and A320, GE's LEAP engine is just utterly dominant. It's the exclusive engine on the Boeing 737 MAX, and it holds a commanding share on the Airbus A320neo. Meanwhile, its main rival, Pratt & Whitney's GTF engine, has been just slammed with major durability problems, which, you guessed it, pushes even more business GE's way. This incredible market position lets GE ride two huge tailwinds at once. You've got the commercial supercycle in full swing, right? Post-pandemic travel is roaring back. That forces airlines to order new planes and fly their existing ones more, which drives that all-important services revenue. And at the exact same time, you have a defense supercycle driven by global instability, boosting demand for GE's military engines that power fighters like the F-16.
And the financial results? They tell the story pretty clearly. The company saw impressive revenue growth, up 10%. But the real story here is the operating profit, up a massive 30%. That shows you some incredible operating leverage. As that high-margin services revenue grows, profits are growing 3 times faster. It's just beautiful. Now, this might be the single most important number for any investor trying to figure out the quality of this business. GE's free cash flow conversion is over 100%. So, in simple terms, what does that mean? It means for every dollar of profit the company reports on paper, it's generating more than $1 in actual cold, hard cash. That, my friends, is the hallmark of an exceptionally high-quality business.
Okay. A dominant market position, powerful tailwinds, fantastic financials. It all sounds almost a little too good to be true, doesn't it? So, what's the catch?
Well, the bear case, the argument against the stock, it isn't really about the quality of the company. Pretty much everyone agrees the company is fantastic. It's about the price of the stock. The core argument here is that after a huge run-up, GE Aerospace might just be priced for absolute perfection. And this is the number at the very heart of the bear case. The stock has been trading at roughly 40 times its forward earnings. Now, that is a very, very rich valuation. It suggests the market expects nothing short of flawless execution for years and years to come. And just to put that number in context, let's look at its direct competition. GE trades at a huge premium. It's nearly double its main rival, RTX, and well above its European competitors, Safran and Rolls-Royce. So when you buy GE, you are paying a premium price for a premium company, no doubt about it.
That high valuation leaves absolutely zero room for error. Any stumble, any hiccup could cause a sharp drop in the stock price. And there are real risks to watch. GE's fate is tied to just two main customers, Boeing and Airbus. The global supply chain is still pretty fragile. And there are technical challenges, like the constant delays to the new Boeing 777X and making sure that workhorse LEAP engine is as durable as it needs to be. And look, this isn't just a gut feeling. It's backed up by some serious number crunching. A lot of models suggest that when you project out future cash flows, the stock, at its recent highs, might be significantly overvalued. And this is the core tension of the whole investment debate.
So with such a strong bull case on one side and a really compelling bear case on the other, what should an investor actually watch to see which story is winning out? Let's build out a little dashboard of the key things to monitor.
Here's your checklist. First, keep a close eye on the LEAP engine's performance. Are those new durability upgrades actually working as promised? Second, watch the supply chain like a hawk. Are parts flowing more smoothly? Third, the Boeing 777X certification. Getting that plane in the air is the key to unlocking a huge new revenue stream. And finally, watch the defense business. Can it keep improving its profitability?
Ultimately, the entire bull case rests on this one powerful concept. Analysts often call GE Aerospace the company with the widest moat in industrials. A moat, of course, is a competitive advantage, and GE's is built on that massive installed base, the incredibly high cost for an airline to even think about switching engine providers, and its lead in technology. It's basically a fortress of a business. Which leaves us with the final, critical question for any investor. We know the quality of this asset is just undeniable, but is owning a piece of the widest moat in the industrial world actually worth paying that premium price? That is the multi-billion-dollar question the market is trying to answer right now.